Hi, my name is Parker Heckman.
Hi, I'm Connor Castro.
I'm Inez Laya.
We're here to talk to you today about the pros and cons of the 6 capital budgeting methods. Starting off with the most accurate method is the NPV, the net present value. And this is the summation of all the inflows and outflows discounted back to the present value, which means it captures the worth of an investment in today's dollars using some discount rate. And it essentially, a flaw of this method is that it requires sound cash flow estimates in order for the valuation to be accurate, but it is still the most accurate as long as you get sound estimates. Now, if the NPV is positive, the project should be accepted, so it's pretty easy to determine whether or not you should accept or decline the project. Now, when ranking projects with you're using the NPV valuation method, the project with the highest NPV should always be chosen as long as the NPV is greater than 0.
The second most powerful capital budgeting practice is the modified internal rate of return, also known as the MIRR. The MIRR is a discount rate that equates all of the present value outflows with the future value of all inflows. Some of the major advantages associated with MIRR is that it provides an answer for cash flows in the future that are not always the same. Additionally, returns on investment are reinvested at the cost of capital instead of the project's rate of return. Additionally, it is very closely related to net present value and takes into account the time value of money. Unfortunately, MIRR is the most difficult to calculate, but often gives you the best results. The third best capital budgeting practice was the internal rate of return. Now, the internal rate of return is a discount rate that equates the net present value of all projected series of cash flow payments to 0. Some of the major advantages of the internal rate of return is that it's closely related to NPV, so like MIRR, many of the decisions are closely related to NPV. Additionally, it's easy to communicate to investors, entrepreneurs, and students alike. Some of the disadvantages with the internal rate of return is that it may result in multiple different answers, especially if the investments are mutually exclusive investments. Returns on the IRR are reinvested at the rate of return instead of the cost of capital in the MIRR capital budgeting practice.
The fourth and fifth most reliable capital budgeting methods are the discounted payback period and the payback period. The discounted payback period calculates the number of years it takes to break even by adding positive discounted cash flows from investment profits while keeping time value of money. Nonetheless, it may also reject investments with positive and negative NPVs. The payback period is the length of time required for the investment to recover its initial funds. While it does ignore time value of money, the payback period does adjust for uncertain future cash flows. Both are easy to comprehend and are biased towards liability, but both become unreliable because it's required random cutoff points and therefore do not account for cash flows beyond that cutoff point, and are biased towards long-term investments such as new investments and capital investments.
Lastly, the least reliable capital budgeting method is undoubtedly the simple rate of return, or otherwise known as the average accounting return. And the simple rate of return expresses the average profits generated each year as a percent of the original investment. Now, the slight difference between the simple rate of return and the average accounting return is that instead of average profits generated as a percent of the original investments, this average accounting return method generates the same result using average profits as a percent of the average book value. So there's a slight variation between the two, but still very similar. Now, investments are ranked according to their rates of returns, so the higher rate of return, better. Now, acceptability is based on comparisons to the investor's required rate of return as well. Now, advantages of this method are that it's very, very easy to calculate, and the needed information is usually readily available. And there are some flaws of the simple rate of return, which is why it's the least accurate. Flaws of the simple rate of return are that it does not consider the timing of the cash flows, aka it leaves out the time value of money, which is very inaccurate. Now, it uses a arbitrary benchmark cutoff date as well, which takes away a lot of the reliability of this method. Now, recapping the 6 methods, the following order that you should be using based on reliability would be 1, the net present value, 2, the modified internal rate of return, 3, the regular internal rate of return, 4, the discounted payback period, 5, the normal payback period, and lastly, the simple rate of return. Thank you very much.